Hey everybody, Preston Brent here with our weekly roundup with our trader user group. This is for the trading week ending April 12th, 2019. Well, I see this market as kind of a Jack and Jill market. You remember that old nursery rhyme? Jack and Jill went up the hill to fetch a pail of water. Jack fell down and broke his crown, and Jill came tumbling after. Well, instead of fetching a pail of water, it's the fear of missing out. So everybody's jumping in to grab that pail of water or pot of gold, and the markets are continuing to climb higher. This past week, the Dow was the only U.S. index that actually closed in the red for the week, just 5 basis points. The S&P was up about 51 basis points, that's 0.5%. Nasdaq up about 57 basis points. The Russell was, for all practical purposes, flat, just barely up, just a couple of points, barely. But we did see volatility come in dramatically. It closed the week at 12.01. I mean, it came down a pretty good bit. World markets, we saw a downdraft in the German DAX, China, and FTSE, which is the London markets. France was up, the CAC 40 was up about 0.5%, and the Nikkei over in Japan, the Asian markets, was up about 29 basis points. So, and for the week, the best performing sector was banks, which doesn't surprise me since we've got earnings officially kicked off this past Friday, and we saw both JP Morgan, Wells Fargo, and PNC all beating a very low bar, and they came in their earnings beat, so we saw them finished higher going into the weekend. So not surprising with a very low low bar. Excuse me. Set for the banking sector that it finished the week at 1.57% higher. And the worst performer for the week was healthcare, down 2.53. PE ratio, the forward guidance, is getting closer to 17, so it's starting to creep on up there. And why shouldn't it, with interest rates down as low as they are right now? In fact, we saw the minutes of the Fed meeting this past week. It kind of indicated that interest rates are going nowhere right now. But what I found really amazing was that the odds of a rate cut over just a 1 week period of time dropped from 50% down to almost zero. Now remember, going back a few weeks ago, the odds of a rate cut, not a rate hike, but a rate cut, was 50%. And I think going back even further than that, 3 or 4 weeks, a month ago, is like 65% for a rate cut. Now we're seeing it's almost zero. So that shows you how fast sentiment can change, which in a way kind of outlines the uncertainty of the current markets. I mean, excuse me, the markets are so uncertain. Trading volume is near the lows that you typically see around year-end holidays. I mean, really low. So, and you know, this past week we did see the IMF, that's the International Monetary Fund, then came out and lowered its global growth estimates down to 3.3% from 3.5%. So things are coming very low. And as I said, the VIX closed out the week at 12.01. So, you know, I don't know if that shows complacency in the markets or confidence. You know, time's going to tell. But I will say one thing. There's a record of shorting activity on the VIX right now. And the last time we had record shorts out there by big funds, big money, was leading into the December 2018 highs, and then we had the crash. And that, because you remember, the only way you close a short position is by buying to close the position. So that is going to spur a ton of buying in the VIX with all these shorts, and that's going to exacerbate the next pop that we have. So just keep that in mind. And last February, or February 2018, going back a little bit over a year and a month or two, we saw the XIV crumble and go under. It went from $91 a share to totally dissolve the very next day because of all those shorts being bought back in the market. So just keep in mind that when you've got a record number of shorting activity, because you know there's a large group of folks betting that volatility is going to stay lower. And when you get in that situation, then we have systematic risk to a huge volatility spike. So this is a time to be picking up hedges for your portfolio for sure. All right. I mean, it's just something that you've got to really be on the lookout for. Now, as I said earlier, JP Morgan, Wells Fargo, PNC, all bank stocks beat very low bar hurdle rates. But as we get into next week and the week after, we got more banks, but we're starting to get into the thick of earnings season over the next couple of weeks, and everybody's going to be paying attention to forward guidance because the markets right now, with the PE ratio the way it is pricing in interest rates to stay lower and inflation to stay low for the remaining part of this year. And remember, the Feds in their Fed meeting minutes, they did come out and say we can raise rates or lower rates depending on where the markets go. So if the markets start to explode higher, and there is that possibility, and you get that fear of missing out, accelerating an upside move, I'm going to be more interested in looking at shorting positions because we're starting to get into a situation where if interest rates do start moving higher, inflation does start moving higher, and the markets don't have that priced in, that does give us a little bit of a nice little pullback. Hence the Jack and Jill scenario that I pointed out in that nursery rhyme. And sometimes I think nursery rhymes are more suited for the financial markets than anything else. So what you see on the screen here is the S&P 500 E-mini futures. You can see this regression channel. I mean, we've been stuck in this thing almost for the entire quarter. I could have run the channel back even further, but we've been in this regression channel where when we get the dips, you want to be buyers. When you get up at the top, you want to hold off on buying. You want to be more of a buyer in the middle to the lower end of the regression channel. It helps, for those of you that are relatively new in trading, it'll help you with timing and playing a bull market. You can see these lines coming left to right across the screen. These are my value areas, and I have them plotted using market map, and it goes back. You can see here these market maps. It plots the yellow line is the highest volume area in this 90-day window. And you can see sometimes multiple yellow lines and other times just one, like right here. And it shows where all the volume is, where bulls equal the bears. Now you can see the last higher volume area was situated right around 2908, and that's right about where we are now. We had a new 2019 high this past Friday on the E-minis at 2914.75. In fact, we closed pretty close to it. And you see how far away we are to the all-time highs at 2947. So it's not going to take but just a hop, skip, and a jump and a couple of good earnings and then more mood and sentiment strength, and then boom, we're over and made new all-time highs. Okay, you can see that regression channel just riding right up there. And I can see us making these new all-time highs really, quite frankly, very easily. There's no divergences in the MACD. There's no divergences in the RSI. So I just think right now we're still in a buy the dip. And you want to be careful buying towards the upper band of this regression channel. Right now, I wouldn't be an active buyer. I would sit and wait for a little bit of a pullback or just see how market price action shapes up with the earnings that we've got this week. It's going to be a big week for earnings. And as a reminder, this Friday is a U.S. holiday, but it's also going to be a holiday generally throughout the world. We've got German markets, UK, markets are closed. A lot of European markets are closed on Friday for Good Friday. So it's going to be a holiday shortened week. We got a nice, enjoyable long weekend. So I think the markets are going to just tend to be bullish. Over here in the U.S., for those of you in the U.S. listening to this update, tax day is on Monday, this Monday, the 15th. It's tax day. So all federal returns are due, except for residents, of course, in Maine and Mass, where they always seem to have 2 extra days for some of their holidays that they take. So this is kind of where we're sitting right now. If we look at the Dow transports, look at this chart action here with this regression channel. I was a little bit concerned because we were moving lower in the transports, which tends to be a leading indicator for the markets. And then we just ripped a new one. As soon as we took out the regression channel here on 329, the end of March, and then in April, we're moving right up to my target area. Remember, I had this target area up here at 197.31. Roughly, I had that up there way back going into the middle of March when the transports were coming down. It was forming this 4-leg and an Elliott wave 3-4-5 pattern. And now we're coming right up. I expect, and we made new 2019 highs, by the way, on Friday as well. Now look at this chart. You can see where we're sitting. And look at the Russell chart. It's very eerily similar. Here's the daily chart of Russell. You can see this regression channel relatively tight, and where we've breached the regression channel, it's been to the downside, not to the upside. And we just breached it like the transports back in early April. And now we're moving up to new 2019 highs, and I've got a projection for a move here up to around 1637 on the Russell. We'll see if it hits that point. But we have not, and also notice these are EMAs. We have not had a cross in the 50 over the 200. We do have 50 over the 200 in all the other U.S. indexes. The Russell is the only one that really lagged or it led the way to the downside in Q4, and now it's lagging here, and it could lead back to the downside. We got to watch this. So I'm watching this along with the transports. If we look at the All World Index, VEU, you can see here, I'll update it. We had new highs on Friday. So the markets are, following the U.S. lead with new 2019 highs. So the markets seem to be exuberant right now. And if we look at Nasdaq, that also, we made new 2019 highs, and we're even closer to all-time highs in Nasdaq. This is NQ, the Nasdaq Futures. And if we look at the index, you'll see the index here is very similar. The cash index, you can see here we're near all new, the all-time highs, which were made in 2018, but these are the 2019 highs, so we're fairly close, okay? And you can see just this huge move up that we've made. I see no divergences here, so money's coming in. And then, of course, if we look at the FANG index, you can see here that we're also at 2019 highs on the FANG index. So, and we're at this value area that was set up here back in going into the end of the summer of last year. So we're very strong in these markets right now. The bar has been lowered. Like I said, earnings are forecast to come in year over year with a decline of 3.5%. So the markets are making a big bet. The bet is this: interest rates are going to stay at or around current levels, relatively low, and inflation is going to stay relatively low and benign, keeping the Feds out of the game. If that's the case, then we see improved earnings in the second half of the year. That's the bet the markets are making right now. So if we get a change in any of those, and we're going to know in forward guidance coming up over the next 3 weeks just what the Q1 earnings confessional gives us. And if we do see the guidance getting better as we move through the year in Q3 and Q4, Q2, 3, 4 of next year, if the guidance stays strong, interest rates stay low, we're going to run up and break 3,000. It's just going to be an easy bet. Now, I know there are a lot of gloom and doomers out there, and I don't mind being a gloom and doomer, but at the right time. There are a lot of people that are always right, but their timing is off by a year or 3 years or 4 years, or some of the gold bugs, decades. So you don't want to sit on the sidelines. I mean, this is a move you just do not want to sit on the sidelines on. And the best way to time the move is just use regression channels. And by using a regression channel, and you can tell in the direction of the regression channel, always buy at the lower end of the channel, sell at the upper end. If I were to put a regression channel, it doesn't matter what you put it on. I'm going to put this one right here on the right the low here, and just put it on the peak right there. You can see, you want to be a buyer, and you can see here we've kind of stayed in the upper band of this regression channel. Every time it comes down to the middle section of the channel, then you want to be looking at maybe buying and setting a stop below the bottom of the channel. It doesn't matter what asset class you're looking at. You can see the MACD, there is no divergences. So this just tells me that's where we're going to go. Now, if we look at volatility, check this out, guys. We finished at 1201. I mean, we haven't been this low. Let me just go back and see when was the last time we were at that low. It was right back here before we had this huge vol pop in beginning of October. So in the beginning of October, which kicked off Q4, that was the last time we saw a vol down this low, right? And in fact, right before October, in fact, October the 3rd, vol was down around 11.27. And then within a week, we went from 11.27 all the way up to almost 30. So that shows you what volatility can do. So remember, down in these areas down here, you want to be very, very careful with credit spreads. I mean, I color code my VIX on purpose, not just because I like Walt Disney movies. And you can see here, when you're in the green, that means we're very low. So you want to be basically long gamma type trades. Short gamma trades down here is very difficult to do. For our members, we cover this in our option masters extensively, as well as in our weekly roundups. But option masters covers this kind of stuff. And as you move up the color band, we want to shift more towards shorting gamma up in this area here. But down here, you want to be mostly long gamma in your option trades. Now, if we come over here and look at the front and the back month futures, the other thing that we do is we love to trade VXXB. And by the way, I think the owner of VXX or VXXB, they're going to change the name back to VXX, I think in May. So we're going to go back to the common equation that we've always known and love, or symbol, which is VXX rather than VXXB. But you can see the term structure here. We're in the green, so that means we're in a contango environment. All right. And then I think next week, Volatility Futures is going to expire, and we're going to move out to May term structure. But this is the front month term structure. We're in contango. And if we look at the back month term structure, which really drives the roll yield in VXXB, look at this, man. I mean, we've got a huge negative roll yield. We're down here deep in the green, over a short 2 points, right? that essentially means that the back month is higher by 2 VIX points than the front month in Volatility Futures term contracts. So this is just setting us up for a huge spike in volatility. And you can never predict when, but we're going to be looking at FUBARs in our group, and it's a military term that I use for our hedge trades. We call them FUBAR trades, which means effed up beyond all recognition trades. So we're going to be setting up what we call the FUBAR hedge. And there are a number of ways to do it. It depends on whether you have a portfolio margin account or a Reg T account. And for those of you that, if you don't know what kind of account you have, more than likely, 99% of the time you have a Reg T account. You got to know if you got PM account, because you got to take tests and qualify to get them. So, but anyway, we got members that have both, and for portfolio margin, you put on FUBAR, slightly different, and you have the luxury of having a PM account where you can change how you do your hedge trades. But this is where we're looking at volatility. Now, of course, if we look at treasuries, we actually saw bonds come down just a little bit, which meant yields went up. I think bonds are going to come back down to our value area here around 145.26, which basically means that interest rates are going to stay relatively low for time being. If we look at the 10-year rate, let me just get it on the 10-year rate right here. You can see on the 10-year rate, remember my target, which I said we would chop around, was 2.5 on the 10-year. And we came down, blew right through it, came up, went down, and now we're up again. I think the 10-year rate is slowly going to edge its way back up to this value area around 2.67. 2.7 area, and then kind of hang out there for quite some time. And it's not going to go much higher unless there's signs of inflation coming out. And we got the CPI numbers this past week. There were no signs of inflation. All right. So we're going to stay suppressed or subdued in interest rates, which keeps bonds relatively elevated, right, for the time being. All right. You can see this Elliott wave 3, 4, 5 pattern. Now we're going to get just an ABC kind of chop until we kind of determine which way we want to go from there. Currency wise, well, you guys know on the British pound, it's outside the regret. You see how wide the regression channel is. So I said you want to be more of an active buyer when you're inside the channel, but at the bottom, and a seller when you're at the top. We're hugging the bottom of the channel. Now, this is all the pound obviously trades related to the what's going on with Brexit. Now that they bought more time, you can see we're kind of setting up for this pattern right here. Let me just kind of see if I can't draw it in here like that, right? And you can see the descending triangle here like this, and that would tend to set us up for a move to the downside. And we did break out of this regression channel here, and we're hugging this bottom here. So it's the pound is a very difficult one to trade around the Brexit because there's a lot of it's subject to headline risk. And I think over the next couple of weeks, we'll get an idea of whether the pound wants to break this down sloping line right here and get back inside the channel. If it does, then that would be a good long signal because we'll probably, at a minimum, move to the center of the channel, right? Which would be challenging that prior pivot high right there. That would be the most likely move if we get back inside this channel for those of you out there that like to trade futures, currency futures, or the Forex. Now, with the euro, as you guys know, I'm longer term. The euro to me is just a dead animal, but near term it can go anywhere. And you can see this wide regression channel here, and I've been more a believer in shorting the euro and going long the euro, which means I would want to see it get up in this area here before I entertain looking at a short. Right in this area here. Remember, it's choppy, but we're clearly no doubt the direction it's going. And that would mean just the opposite, the US dollar, right? So if we look at the dollar, it kind of goes where the euro, it goes in the opposite direction of the dollar. But we've been pretty much, I mean, there's almost no trade here. If I would have put a regression channel on it and just come from this peak here to where we are here, I mean, look at that. Look, first of all, look at how wide it is. I much prefer a tighter regression channel. If you see this little number here, it says 0.56. It measures the width of the channel. The higher that number, the tighter the width, which makes it easier to trade. When you get these really wide anomalies here, when you get down to the bottom, you want to be a buyer. When you get to the top, you want to be a seller. We're right in the middle here, so flip a coin, right? I mean, flip a coin which way it wants to go. If the global economy starts to improve, the dollar is going to get weaker, and we'll see strength in other currencies. I would just kind of leave it at that, right? Energy, oil. Well, again, it is a play on global growth, but more important, there's too much geopolitical risk right now. You can see this regression channel. Down here, we had a signal to go long oil. Back on December 27th, I sent a signal out, go long oil. There was a trigger. It was a good move. We had some, our members take it, really huge move because you're going long oil. I mean, down around $45 a barrel, right? It's $1,000 a point. And it's sitting up here around $63 a barrel right now, almost 64. It's a huge move. You know, it's about $20 a barrel. It's $20,000 per contract. There is no divergences here. That means the oil markets, and if you look at the term structure of oil futures, it is in a backwardation. That means the closer dated oil futures contracts are priced higher than contracts out a year from now, right? And it's priced higher because there's a lot of geopolitical risk around Venezuela, Iran, Libya, and the Saudis with their production cuts. So that's why I had said oil would get up to the low 60s, and then I would be more an active potential buyer or seller of shorts. But I'm going to hold off for now because this geopolitical risk could push this up even higher. So I'm holding off right now. But if you take that off the table, oil is going to come back down in the low to mid or to the mid to high 50s in a heartbeat. But that's still on the table, so they're keeping their thumb on the pressure of oil production. And I think eventually it's going to be a demand issue rather than a supply issue, right? With the global growth. If the global growth story comes back, then you're going to see oil move back up. But if it goes away, then you're going to see oil come back down. The only thing keeping oil up now, as I said, is the supply side with some of the geopolitical risk and production cuts that they're running. Okay. And then, of course, if we come over to metals, let's look at gold. Gold is in this flat bind right here. I think the original cup and handle pattern is off the table, and then I had projected a head and shoulders pattern in this to the downside, but we haven't gotten a break of the neckline, and now we've got this other little, morphed mini right shoulder kind of pattern playing out here. So to me, it's a no trade in gold right now. Okay? It's just no trade. If we take out this prior pivot here and get up above 320 or so, then I may be interested in a run up to 350. But outside of that, no. Okay. The other one that I talked about as a bonus round for you guys was lean hogs. It was our when pigs fly short. Remember, at this level here, I said, don't short. Let's wait for a higher high. And sure enough, we got it. And we did get a a divergence on this thing, but we're not clearing my pivot low right here, sitting around 92.99. So call it 93, right? So we're sitting in this area here. If we take this out, then we should come down and at least test this 80 area right here. Should this break, it's free powder. It's just, all powder all the way down to here. And this is because of the swine flu. Once they get that fixed, then we're going to see this market come back into fruition again. All right, folks, for our members, I will see you this Sunday evening for our weekly market watch. If you're not a member, I highly encourage you to come in. We're having a good time making good money in the markets. Whether you got a Reg T account or a portfolio margin account, there's different trades that you can use and different ways to use option to leverage the margin that you do have, but in a safe, risk-oriented fashion. All right, everybody, have a great weekend. I will see you members. I'll see you this Sunday evening. Ciao, folks.